If you've spent any time on ETF Twitter, Reddit, or YouTube lately, you've probably seen the ticker QDTE thrown around with numbers that seem almost too good to be true. Weekly payouts, distribution yields above 40%. But here's the problem. Most people talking about QDTE have no idea how it actually generates that income, or what investors are giving up to receive it. If you're new to the channel, my name is Rachid. I'm a CPA and I hold a master's degree in finance. My goal is to help you understand ETFs and investing with clear, unbiased, and practical explanations. By the end of this video, you'll understand exactly how QDTE works. Let's get into it. Let's start with the basics. QDTE is an actively managed ETF that gives you exposure to the Nasdaq 100. So think of the same 100 companies that make up something like QQQ, big names like Apple, Microsoft, Nvidia. But QDTE isn't trying to be a growth fund. Its entire purpose is to convert some of that growth potential into cash you receive every single week. That's a fundamentally different goal than a fund like QQQ, which just wants to grow your money over time and hands you a small dividend a few times a year. QDTE flips that priority. Income comes first, growth is secondary. And that one design decision is going to explain almost everything else you see on this fund's fact sheet. The yield, the risks, all of it traces back to this core trade-off. So how does the fund actually pull this off? This is where it gets interesting, and where a lot of investors get lost. QDTE doesn't simply buy the 100 stocks in the Nasdaq 100 the way a typical index fund would. Instead, it uses something called synthetic exposure. Think of it like this: instead of literally owning a rental property, you could use financial contracts to get paid as if you owned it, without ever holding the deed. That's roughly what's happening here. QDTE uses options contracts to mimic owning the Nasdaq 100, which gives the fund managers more flexibility to layer their income strategy on top. Then, every single day, the fund sells what are called zero-day to expiration options, ODTE for short, on that Nasdaq 100 exposure. These are options that expire the very same day they're sold. Selling these options is what generates the premium, which is essentially rent that other traders pay QDTE for the right to potentially buy that upside from them. That daily premium collection is the engine behind the weekly payout you see advertised. Now let's talk about where that income actually comes from, because this is the part that trips people up the most. When QDTE sells these call options, it's agreeing to hand over some of the stock market's gains if the Nasdaq 100 goes up a lot that day. In exchange for making that promise, it collects a premium upfront, and that premium is pooled together and distributed to you weekly. Here's a simple way to think about it. Imagine you own a house, and every week you sell someone the right to buy it from you at a slightly higher price if it goes up in value. They pay you cash for that right. If the house barely moves, you keep your house and the cash. But if the house jumps in value, you have to sell it at that lower agreed price, missing out on the extra gain. That's the exact trade-off happening here, just with options contracts instead of a house. You're being paid today, but you're giving up a portion of tomorrow's potential upside. That's not a flaw in the strategy, it's the entire point of it. But it's critical that you understand you're not getting this income for free. This naturally leads us to the risks, and I want to be direct with you here, because a lot of content online about high-yield ETFs glosses over this part. First, there's capped upside. Because QDTE is constantly selling away its gains through these calls, if the Nasdaq 100 has a huge rally, QDTE typically won't capture the full move the way QQQ would. Second, there's NAV erosion, NAV standing for net asset value, which is essentially the fund's share price. In some environments, especially if the market is flat or declining, QDTE's share price can gradually decline over time even while it keeps paying out income. Third, volatility risk. The premiums QDTE collects are directly tied to how volatile the market is. Less volatility often means smaller premiums, which can mean smaller future payouts. And finally, and this is the big one, there is no downside protection. If the Nasdaq 100 drops sharply, QDTE drops too. The options strategy generates income, it does not act like insurance for your principal. A common mistake I see investors make is judging one of these income ETFs purely by its distribution yield, without asking what's happening to the actual share price underneath it. A fund can pay a large yield and still lose you money overall if the NAV keeps sliding. Yield and total return are not the same thing, and we'll come back to that distinction in a moment because it matters enormously. One of the first numbers investors notice is QDTE's impressive distribution yield. As of July 21, 2026, the fund had a distribution rate of approximately 40.27%, and it pays weekly, making it very attractive for income-focused investors. For example, the most recent distribution was $0.230242 per share, paid on July 24, 2026. That means if you owned 100 shares, you would receive about $23.02 for the week. With 500 shares, your payment would be approximately $115.12, and with 1,000 shares, about $230.24 before taxes. However, remember that these distributions are not guaranteed. They can increase or decrease depending on option premiums and market conditions. Most importantly, a high distribution yield does not necessarily mean a high investment return. Always look beyond the yield and evaluate the fund's total return and NAV performance over time. QDTE's weekly distributions can come from multiple sources, and understanding this is essential. The first source is option premium, which is the income earned from selling daily options. This is the fund's primary income strategy. The second source is capital gains, which may occur when the portfolio sells investments at a profit. Finally, part of a distribution may be classified as return of capital, or ROC. This simply means a portion of the cash distributed comes from the fund's capital rather than current investment income. Return of capital is not automatically good or bad, but investors should understand what portion of each distribution comes from each source. That's why you should never judge QDTE by its yield alone. Always look at the fund's total return, NAV performance, and the composition of its distributions. As of June 30, 2026, the fund delivered an impressive 32.22% total return over the past year. Since its inception, it has generated an annualized return of 23.52%. Those are strong numbers, but it's important to keep them in context. QDTE launched during a period when the Nasdaq performed well and option premiums remained elevated, creating a favorable environment for its strategy. Because the fund is still relatively new, we don't yet have 3-year or 5-year performance data. Investors should avoid assuming these returns will continue indefinitely. Instead of focusing only on the past returns, ask yourself whether the strategy fits your investment goals. QDTE may be an excellent income-producing satellite holding, but it's still important to maintain a diversified portfolio and have realistic expectations for future performance. So who is this actually built for? Based on the strategy itself, QDTE tends to make the most sense for income-focused investors who specifically want frequent cash flow and are comfortable with the trade-offs involved, and for more experienced investors who already understand options strategies and are not surprised when capped upside or NAV movement shows up in their statements. It's generally not a great fit for growth-oriented investors, because you're intentionally trading away long-term upside for near-term income, which defeats the purpose if growth is your primary goal. If you do decide QDTE has a place in your strategy, the general guidance from most professionals is to treat it as a satellite holding, a smaller, supporting piece of a diversified portfolio, rather than a core position or your entire portfolio. Concentrating your whole strategy into a single high-yield options income fund removes the diversification that's supposed to be protecting you in the first place. For Canadian investors specifically, there are a few extra layers worth knowing since QDTE is a US-listed ETF. Because it's American, distributions can be subject to US withholding tax, and where you hold this fund matters a lot. Holding US ETFs inside an RRSP is generally treated differently than holding them inside a TFSA under the Canada-US tax treaty, and that difference can meaningfully affect how much of your distribution you actually keep. On top of that, remember what we discussed earlier, a portion of these distributions may be classified as return of capital, which itself carries its own tax treatment that differs from a regular dividend. This isn't something to guess your way through. If you're planning to hold a meaningful position in a fund like this, it's worth taking the time to understand exactly how it will be taxed in your specific account type, because taxes can significantly affect your real, after-tax return. If QDTE's overall approach interests you but you want to compare options before committing, there are several alternatives worth knowing about. XDTE follows a similar daily options strategy but is built around the S&P 500 instead of the Nasdaq 100, which generally means somewhat less concentration in tech. JEPQ and JEPI take a more traditional monthly covered call approach rather than the daily 0 DTE method, generally producing a smoother, less aggressive income stream. And QQQI is another Nasdaq 100 linked income strategy worth putting side by side with QDTE. The key here isn't to assume the fund with the biggest yield number wins, it's to compare how each of these actually generates its income, because that mechanism is what will determine your real experience as a holder over time. So, let's bring this together. QDTE is a genuinely innovative strategy, and its income potential is real, it's not a gimmick. The mechanics behind it are legitimate and well understood in the options world. But excellent income potential comes bundled with real trade-offs, capped upside, exposure to NAV movement, and zero downside protection. This fund is not inherently good or bad, it's a tool designed for a specific job, and it will only serve you well if that job matches what you actually need from your portfolio. If you're chasing high weekly cash flow and you fully understand what you're giving up for it, it can be a reasonable satellite holding. If you're trying to grow wealth over the long run, this probably isn't the vehicle to get you there. And whatever you decide, please walk away from this video remembering the one idea I keep repeating: a high headline yield is attractive, but total return is what actually builds wealth over time. Never choose an ETF based on yield alone. If this video helped you understand QDTE more clearly, do me a favor and hit that like button, and subscribe if you want more honest, no hype breakdowns of ETFs like this one. And in the comments, let me know which ETF you'd like me to break down next. I read every single one. See you in the next video.